Hey everyone, welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're going to be talking about leverage. So when it comes to trading in general and options trading specifically, we get a bunch of leverage with that. So instead of just buying stock outright and paying the full amount for stock, if we have a margin account, we get some leverage, and using options, we have some additional leverage as well in that same very margin account. So let's get right into it, and we'll talk about a few different examples of different situations where leverage can help us or hurt us. So the first thing to understand when we're talking about leverage is that it can magnify our wins but also magnify our losses. So anytime we're dealing with a leverage situation, and specifically with trading, we're talking about being able to put up less capital than required for a certain trade, which allows us to enhance our return on capital. So as you can see at the top here, the use of options or margin account to increase return on capital is my definition of leverage. So let's go to the next slide, and we'll talk about a few examples when it comes to leverage specifically. So right here we're going to be talking about a margin account and different ways of buying stock. So let's say we've bought long stock at $100 a share, and we're going to be talking about 100 shares. So everything you see here is going to be 100 shares of stock. So let's say I'm in a cash or IRA account where I don't have any additional leverage. So if I bought 100 shares of long stock at $100, it would cost me $10,000 to do that. Now, let's pretend that along the line, the stock ends up moving to 110. So that's going to show me a profit since I bought it at 100, and it's going to be a $1,000 profit. So if I've got $10,000 that I put down to buy those shares, and I've got $1,000 of profit, my return on capital, as you see here, is going to be 10%. However, if I am in a margin account and I actually do have that leverage handy, then I'm going to get 2-to-1 leverage on stock. So I can buy the same amount of shares, so the same 100 shares at $100, but it's only going to cost me $5,000 to put down because I'm getting 2-to-1 leverage. So because of that, if I'm up $1,000 on this position, but I only had to put down $5,000, that's going to be a return on capital of 20%. So as you can see, when I'm buying stock in a margin account compared to a cash and IRA account, my return on capital doubles because I'm getting 2-to-1 leverage as opposed to 1-to-1 or no leverage at all when I'm dealing with a cash or IRA account. So what's important to note is that when we have leverage, it increases our return on capital, but it can also increase our losses. So let's pretend the stock goes to 90. If I have the shares here, or I put down $10,000 to purchase the shares, and the stock goes to 90, I would have lost 10% on that investment originally. But if I'm in the same position where I'm only putting down $5,000, it would magnify my loss. I would be at a loss of 20% because I would be losing $1,000 against $5,000 down, when you compare that to $1,000 against $10,000 down. So it's important to note that when we're dealing with leverage, it can magnify our wins, but it can also magnify our losses. So let's move along to the next slide, and we'll talk about leverage with options. So when we talk about options, there's a few different ways that we can get leverage. So in a margin account, when we buy options, basically, it's going to be whatever the capital is that's required, or whatever the debit is paid, that's going to be our buying power reduction. So in any account, I should say, so whether we're dealing with a cash, IRA, or margin account, that's going to be the same. So if I buy an option in a cash account or IRA account or margin, whatever I paid for that option is going to be the amount required for that. There's no additional leverage on buying options. However, when I'm selling in options, that's not the same case. So let's walk through a few scenarios here, and we'll get down to it. So let's say we're buying that same stock at $100 in a margin account. So I've got $5,000 to put up to buy those 100 shares, and if I'm looking at buying power reduction, it's going to be the same value as you see it along here. So my buying power reduction is going to be $5,000 because I'm putting down $5,000 to own those 100 shares. And let's say the stock goes to 105. So now the stock only went to 105 instead of 110. So I would see a $500 net profit here, which is going to give me a return on capital of 10%. So in a margin account, when I just take the profit here and divide the buying power into that, it gives me that 10% value. Now, if I'm looking at buying a long call instead of buying the shares outright, again, with a call, I'm going to have an expiration date. So it's going to be a lot more cost effective in that sense. But because I have an expiration date, I don't have that unlimited reason to be right. So I have to be right in a certain amount of time by a certain magnitude to be profitable. So let's say that I was. So let's say I buy a 100 call for $2. And again, every option contract is the theoretical equivalent to 100 shares. So if I buy it for $2, it's really going to cost me $200. So my buying power reduction, or the amount reduced from my account, would be $200. And if the stock's at 105, my call will actually be worth $500 if I went to go sell it at expiration for full intrinsic value. Because again, if I'm buying a call which controls 100 shares, and that strike price is 100, if the stock price is 105, I have 5 points of intrinsic value there. But since I paid $200 for that, I would take 500, subtract the 200 I paid for it, and that gives me the net value or net profit of $300. So taking this all together, I put down $200 and I netted $300 on top of that. So my return on capital would be 150%, which is much higher than the return on capital of 10%. But let's say I go a different route, and instead of purchasing options, we look to sell a put instead. So this is something more along the lines of what we would do here at tastytrade. So let's say I decided to sell an at-the-money put instead. So I sold a put at 100, and I collected a credit of $2.50, which is really $250. So the reason that my buying power is very different than what you see here is because of the fact that when we're selling options in a margin account, we do get additional leverage. It's not the full amount that's required for the trade. So if we know that a put contract is the right to sell shares at a certain value, if I'm selling someone else that right to sell me their shares, you would think that in an account I would need to put up the full value of those shares. But in a margin account, that's not the case. In a margin account, I might see my buying power reduction be somewhere around $1,900. So in a margin account, I do get that buying power reduction relief, but in an IRA and a cash account, I would not. So I would have to put up that full value of the 100 shares. But since we're talking about a margin account, we'll continue on and see what the return on capital is. So let's say I have a buying power reduction of $1,900 and I collected $250 for selling that put. If my stock's at 105 at expiration, that means that my put is going to be out of the money and it'll expire worthless. Because if a stock's at 105 and the right that is associated with the put is to sell shares, why would anyone who purchased that put sell their shares at 100 when they can sell it in the market at 105? They wouldn't. Which is why that put would be considered out of the money. There's no intrinsic value there. And for that reason, I would be able to keep that premium I originally collected, and it would be profit. So I would be profitable to the tune of $250 against my $1,900 that was reduced for buying power, which gives me a return on capital of 13%. So it's just a bit higher than buying the shares outright. However, what's important to remember is when we're selling options, I can be correct in 2 out of 3 ways. So when I look at these other 2 options here, for me to be profitable when buying stock outright, I need that stock to go up. It can take its time going up if I own the shares because there's no expiration date, but in the end, it does need to go up for me to be profitable. If I'm looking at buying a call, it's the same, but it's going to have to go up by a certain magnitude, and that magnitude can be measured by the amount I paid for the stock, or the call option, I should say. So my break even here, if I'm looking at a 100 call that I purchased for $2, my break even's really at 102. And the stock has to go above 102 before the expiration or by the expiration for me to be profitable. In this case, it did, but if it went to 101, even though owning the stock would be profitable, if the stock went to 101, if I buy the call and the stock's at 101, it would not be profitable at expiration because I need it to be above 102 to be profitable. However, if I sold a put, my break even is actually helping me on the downside. So remember, I collected that $2.50 credit. So if I sold a put at 100 for $2.50, my break even is actually at $97.50. So that's going to give me a lot more room to the downside to be correct. And even if the stock stays right at 100, I'll still be profitable and I can keep that $250 credit because the option would still be worthless as long as it's at 100.00 or above it. So for that reason, I'm profitable in two ways, and that's why this is going to have the highest probability of profit when we compare it to buying options naked and buying stock. So this has been a lot to take in, so let's get to some takeaways and we'll wrap it all together. So leverage allows us to magnify profits, but also losses. So it's important to remember that even though we have all these benefits to the upside and profit side, it can also hurt us if we're not careful. So that's why we make sure that we trade small and we look to keep an eye on our positions and use different management strategies so that we don't put all of our eggs in one basket and get blown out, because that's the last thing we want to happen. Secondly, options and margin offer different types of leverage. So when we're looking at margin accounts and buying stock, for regular margin, it's 2 to 1 for stock as opposed to having no leverage at all and having to put up that full capital. But when I'm selling options, I do have a much more complex calculation that goes into that, and it's going to give me a different buying power reduction depending on what strategy I'm deploying. So when we're looking at margin accounts and selling options, we do get a unique type of leverage in that sense. And lastly, while long naked options offer the most leverage and return on capital, as you saw there, they are going to be the lowest probability of profit. So again, when I compare buying a call to buying the shares outright, for the shares to be profitable, I need the stock to go up, but it can go up over a certain amount of time. There's no expiration date there. But when I'm buying a long naked call, I need that stock to go up in a certain amount of time by a certain magnitude as well for me to be profitable. So it's really tough for those to be profitable at expiration, which is why that's going to have the lowest probability of profit. So this has been an overview of leverage. Hopefully you've enjoyed it. Thanks so much for tuning in. If you've got any questions or feedback at all, shoot it over to or you can shoot me a tweet at. We'll see you tomorrow at the same time.
What's up everyone? Thanks for watching our video. Click below to watch more videos, subscribe to our channel, and visit our website at tastylive.